Hello everyone, welcome back to Girard's Monthly Market Update. I'm Jim Jacobson, and with us again today is Chief Investment Officer Tim Chubb. Tim, lots to talk about today with the Federal Reserve recently meeting and cutting rates by 0.25%. That was headline making, although expected, but it was still headline making because it was the first rate cut in nearly a decade and comes just 9 months after they had raised rates. And if that wasn't enough to make headlines, the market went into a bit of a tailspin over the last week, down about 5% or so. So let's start with the Fed, what they did, what they said, and what we can expect.
Yeah, so the meeting really turned out the way that I was looking for. We got the quarter-point rate cut at 9 months after a rate hike, and just as we were talking about how the Fed raising rates is usually a good sign because it means the economy is accelerating from a growth perspective, wages are growing, and the Fed's trying to keep inflation in check. We've seen a rate cut now, and that usually signs that growth is slowing. That's been the case, so far in 2019. We don't think growth is falling out of bed. The growth has definitely slowed down a little bit, but the economic data actually was pretty good between the last meeting, and you could almost make a case for the Fed not to cut rates, but the big piece is it was an insurance cut, much like they did in the late 90s to try to sustain the economic cycle. It worked successfully then as it really tried to shake off some of the risks that the Asian financial crisis had. And I'm hopeful that this time, I think the Fed is doing the right thing by basically taking that December rate hike off the board that they probably should have avoided in the first place.
So that's the thing. It has to be careful between looking political or backing up or whatever they want to say. But now going forward, there's maybe about a 50-50 prediction of a rate cut in either the September meeting or one of the other two meetings they have in the fourth quarter this year.
Yeah, after the meeting, we got some guidance, I suppose, and basically leaving the door open for future rate cuts as the year goes on. And ultimately, the Fed has said that they're going to be data dependent. And so if we do see a weakening of data, I think the Fed will be quick to act and do another rate cut to help sustain this cycle. But on the flip side, they didn't feel like a 50 basis point cut or half a percentage point was necessary because the economy is not, again, falling out of bed. So it's kind of a Goldilocks type of scenario where the data has been good enough that the Fed doesn't need to enter a sustained period of monetary easing. But at the same time, we're not raising rates. I think the pressure's off on them to do that for the foreseeable future.
And one thing that the Fed has quietly done is they've stopped unwinding the balance sheet. And that sort of sounds like a double negative, but basically they are not putting pressure on long-term rates. It would be the right way to say it. So even though they maybe cut short-term rates, the fact that they've stopped unwinding the balance sheet, that does have a little bit of a slowing effect. So it's not like they're going crazy here trying to overstimulate.
Yeah, for sure. Yeah, I think the market and global central banks are focused on easing monetary policy after what was a couple of years of being hyper-focused on tightening monetary policy to curb the growth and inflation risk.
You mentioned the economic data points too. I pulled a couple from the past week. The ISM Manufacturing Index came in with a score of 51.2, and that is slowing down. I think it was 60.5 a year ago at its peak. But 51.2 still speaks to a growing manufacturing sector. It's just growing slowly. Mm-hmm. And when I read the data, they talked a lot about the uncertainty. So we'll call that the U word. See if we can get away with that, the U word. So uncertainty, and if you're a manufacturing owner or if you're a factory manager, uncertainty is really a difficult thing to deal with.
Yeah.
So I think that is a good reason for the Fed to maybe give rates a little bit of a pause. And then also looking at some consumer numbers, they were quite good. Consumer was very happy. The Consumer Confidence Index number was high. And the Case-Shiller National Price Index showed a gain of 3.5%, which is a pretty historically average number, except if you're growing at 6 and 7%, which is what housing had done for 2 or 3 years. Now we're in a temper tantrum and people are only seeing 3.5% increases. So you have to realize that 3.5 is actually a pretty good rate increase on the housing market. Okay, Tim, let's transition now from the Fed to the recent market turbulence, as we've seen about a 5% drop in the last few days. Trump tweets, there's tariffs. What say ye as to all this hullabaloo?
Yeah, it's been choppy seas recently. The big announcement was the Trump administration decided they wanted to impose another round, their 7th in the last 18 months, of at least threatened tariffs for an additional 10% on $300 billion of imports, which really came as unexpected. We had what we thought was a positive G20. Secretary Treasury Steve Mnuchin and Lighthizer were over in China recently. meeting to discuss, really what we thought was a longer term trade deal. And then we got the announcement on Friday. And so overall, it's frustrating, because I think the economy is doing pretty well. We've had some positive data. The consumer is in really great shape. And this next round of tariffs, as we've talked about, is going to have to be passed on to the consumer. It's not going to be something a lot of companies will be able to eat without seeing a really significant hit to their profit margins, especially those who have large exposure in China. So, overall unexpected and definitely frustrating. And then to kind of accelerate the sell-off, we heard from the Treasury that they've officially put the tag of currency manipulator on China. They responded by letting the yuan really roll. 7 has always been kind of the line in the sand with how much they would allow it to be devalued. It broke 7, and now we've seen some support from the People's Bank of China to really back it up and not let it fall too far. But overall, definitely took the trade tensions to another level.
So with this turbulence, I'm often reminded then of the counterbalance with the bond market. And looking at the indexes over the past year, bonds have quietly posted quite a strong number. Tell us a little bit more about those mechanics.
Yeah, one of the things that a lot of clients sometimes ask us about is, why do I own these bonds, these fixed income securities? And it really goes to times like this where we have a lot of volatility in the market, or at least normal volatility in the market. And we've had a couple years recently where there's been absent volatility entirely. The bond market's up. I think the Barclays aggregate bond index is up about 9% year over year. We've seen high yield bonds even outperform that. And so it's really an opportunity for us, if we believe, and we do, that the economic expansion will continue. We have the Fed support where we are able to sell bonds, which have been strong, into weakness into the stocks and pick up some shares of really great companies and investments that we really like on the stock side of things. So I think it just helps to kind of reiterate, this is why we own them, and it's not just the income that we're looking for, it's the total return opportunity that exists both in the bond market and the stock market.
That makes sense as part of an overall balanced portfolio. All right, well, I'm Jim Jacobson, and again, this is Tim Chubb. Thank you for joining us. We look forward to talking to you again next month.